Hi, I'm Borkin from JBWere's Investment Strategy Group. As we've discussed over recent months, the major macro theme impacting financial markets this year has been the rapid and aggressive policy pivot by central banks as they have come to the realisation that inflation is proving far more troublesome and persistent than first thought. Policymakers, and markets as a result, are grappling with two broad and interrelated questions. The first is, how much does economic growth need to slow to bring aggregate demand back in line with aggregate supply, therefore easing price pressures? And the second is, how much of a tightening in financial conditions is required to achieve this required growth slowdown? Unfortunately, the answers to these questions are still far from clear, which is a key reason why markets have been struggling to find their feet. For central banks, the picture is being complicated by ongoing supply-side forces, which they have very little visibility or control over. Think factory closures, labour shortages, and port disruptions, for example. It has meant that markets have remained in this uncomfortable and relentless feedback loop where ongoing inflation surprises have been followed by even more hawkish central bank rhetoric and actions. But are we possibly closer to some reprieve from these forces? In other words, are we at or past the point of peak inflation and therefore peak central bank hawkishness? Our answer to this is a tentative yes. We say this because there are hints that the inflation outlook is beginning to improve. In the US, a normalisation in household spending away from durable goods and back to services is now well underway, which is easing some of the intense price increases experienced in durable goods over the past year or so. There are also signs that labour market conditions have started to moderate from extremely tight levels, with job openings beginning to slow and signs that wage pressures are moderating. In New Zealand, firms' pricing intentions have fallen for 2 consecutive months, and a sharply weaker housing market will take pressure off construction cost inflation, which over the past 12 months is up a whopping 18%. Now, admittedly, these inflation developments are only tentative and uncertainty remains elevated. Signs of a turn in inflation is more limited in other parts of the world. Until clearer evidence emerges, we doubt markets will truly embrace this peak inflation and peak hawkishness theme. We are encouraged by recent developments, but more confirmation is required. To us, moving past these twin peaks is a necessary condition for equity markets to stabilise. However, that alone is not a sufficient condition. Markets will also require confirmation that the growth picture is holding together. That is, recession will be avoided. Global data flow has been mixed recently, and downside risks are arguably more obvious in places like Europe and even in New Zealand, given the pace at which the housing market has gone into reverse. However, we are holding firm with our view that the odds of a US recession, at least in the next 12 months, remain low. Fundamentally, strong income growth, healthy balance sheets, and a large buffer of pent-up saving are all expected to continue to support reasonable US consumption growth over the coming months. For investors then, our message is largely unchanged from what it has been for the past few months. Under our base case, where inflation pressures do continue to moderate over the months ahead and the growth picture holds together, we believe that some of the price action seen in financial markets this year will prove to be too negative. Of course, there are scenarios where our base case proves incorrect, and we will continue to monitor those risks. Equally though, if the upcoming mix of growth and inflation data moves more in line with our views, then we believe this will help sow the seeds for a better performance from equity markets over the months ahead. I'll leave it there, but as always, please reach out to your JBWere advisor if you have any questions. Thanks.